Okay, well, we'll go ahead and get started. Thanks for coming to class. So this has been a pretty nice couple of weeks. We've really started to tighten up around the peg, which has been pretty exciting. I'm sure that people have lots of questions for Publius. So Publius, I'll pass it off to you, and then I don't know if you want to give a quick update on maybe pod marketplace and anything else that's on your mind, and then we could get class started.
Sure. Maybe just, and this is more of not a protocol specific thing, but we're we're over 6 months from deployment, and that's very exciting. So to be at PEG and be 6 months from when Beanstalk was deployed on mainnet, it's just very exciting. So this week in particular, we've been really looking ahead and thinking big picture about Beanstalk and what needs to happen to not just have Beanstalk become widely adopted on Ethereum, but really to be an essential part of DeFi for the long term. So just a very exciting place for us to see the protocol in, and it's we're very grateful for the community that's forming. So with that in mind, and happy to talk about the pod marketplace if people are interested. We can answer questions, whatever people have on their mind.
Sure. I do have one just kind of a little bulletin item I just wanted to mention. ETH Denver is coming up. If it's from that's in the next few days. I think it's the 11th through the 20th. It's kind of a long range. I may have that off by a couple of days, but we're whipping up some stickers for Beanstalk, and I wanted to know if anyone was comfortable handing those out at ETH Denver. We could send you a roll of stickers, just to promote Beanstalk. So we're whipping up some stickers, and if that's something that you'd be interested in, just shoot me a DM. I obviously understand if you don't want to, dox yourself or be involved, but if you're interested, let me know. Okay, so we're open for questions now. I'm going to go over to the class discussion. And I see that Publius has a question here. I've been hearing that Beanstalk has growth cycles. What factors contribute to its cyclical nature?
Well, supply and demand is constantly changing. The cyclical nature of supply and demand is primarily due to the fact that when the price is above one, or it seems like the price is more generally above one, and therefore there is inflation, that tends to create more demand for the protocol, i.e., it's working. So people look at that and try to come in. And that creates a positive cycle. Similarly, when the price is less than one, some people look at that and say, well, it's not working anymore, and sell. And so that just tends to create a cyclical nature in terms of how the system trends over time. And that's not necessarily exclusive to Beanstalk. It's certainly not. But it's exacerbated when you have a system like Beanstalk with no real intrinsic value or anything of the sort. And so it really is just a question of incentives. And in the early days, you would expect, those cycles to be more exacerbated than as people start to believe in the model and the incentive structures.
Okay, I think that answers it. I had one DM to me by Tbik. I'm just going to read that. Tbik says, hey, Dumpling, I have a question for Publius at University Chat. I'd like to hear more about Publius's philosophy on what a sustainable level of debt for the protocol is.
So ideal equilibrium is defined as the price at $1 or the TWAP at $1 and the debt level at 15% of the bean supply, which is very low. And that's explicitly defined such that the protocol is able to respond anytime the debt level gets really high. It's supposed to basically fully reset. It doesn't need to reset to zero, but a significant paying off of its debt and a true decrease in its debt level to near zero is what a complete deleveraging looks like. So the protocol is working towards that. To answer the substantive question as to what is a sustainable level of debt, that's an impossible question to answer, because the real question is, at the margin, can Beanstalk attract enough creditors or demand for the silo, or in some way can Beanstalk attract enough demand for beans when the price is below $1 to return the price to $1? And that is not definable other than in practice. It's binary. It's either happening or not. And in the grand scheme of things, it's binary in the sense that either the debt level was sustainable or it wasn't. At some point, the system dies if it wasn't. So the fact that the price is at $1, and more than that, it seems like the price is at $1 in a relatively sustainable or strong fashion, is an indicator that the current debt level is not too high, whatever that means. We're at basically 1,500%. What is it right now? Which is really significant. 1478 at the moment, which is significant in the scheme of any system. Having a 15-to-1 debt ratio is an eye-popping number in the grand scheme of things. I don't think that in the long run, Beanstalk wants to settle at this type of debt level. And again, the starting point is the goal is for Beanstalk to deleverage entirely. I think the thing that it might be helpful to appreciate is, in a similar way to, it's unlikely that if the price returns to 24 cents again, Beanstalk would be able to recover, or at least the recovery would be much more difficult than the recovery from 24 cents when the protocol was young and small. In a similar way, it's going to be much easier for Beanstalk to deleverage and demonstrate a real proof of concept, like it did from returning the price from as low as 24 cents back to $1. And, over the past month or two, as we were at 90 cents, 80 cents, people look back at those much more risky times at 20 cents, 30 cents, or 24 cents, 30 cents, and have more faith at 80, 90 cents. In a similar way, I think right now the protocol is kind of building its history and building its credit history. And so while the pod rate, the debt level is particularly high, in the future that will hopefully be good reason for people to lend to Beanstalk at a 500% debt level, for example. So in the context of things at the moment, I think it's important to realize that last time Beanstalk went through a mini growth cycle around Thanksgiving, where again, the soil parameters weren't properly set. So the pod rate increased during that time, even though it should have decreased significantly if the parameters were properly set. The bean supply increased by 150% from around 20 million to around 50 million. And if that happened again, not to say that it will, but if, let's call it 100% increase at some point in the bean supply in a short period of time, that would, under the current parameters for soil, effectively result in a halving of the pod rate. And so already when you get down to a 750% pod rate, a 1,500% pod rate looks pretty good on the record in the grand scheme of things. So is this sustainable? Who can say? But I think, at least in our perspective, this is looking more and more sustainable. The fact that the price is maintaining its peg more and more consistently is very encouraging. And that's step one towards getting to a place where the pod rate can decrease. And, while I think there are some places the efficiency of the overall model can be improved, I don't think that the soil is one of them at the moment. And therefore, we're very excited to see whenever it is that we go through a larger short-term growth cycle. And not to say that that'll happen anytime in the near future, that really should kick off a larger deleveraging.
Great. Mod, you hopped on up, so go ahead and ask your question.
Hi guys, how you doing?
Doing good, doing good. Nice to hear your voice. What do you got for us?
I have a series of questions, so I may not ask them all in a row. Just we can take a break or go with it. The first two are around the field. I understand and I agree, completely agree with Publius that whatever inefficiency problem that we're having here is not stopping us from maintaining PEG or continuing with it. So what the two questions that I'm going to ask right now, well, they're not a priority. It's for the sake of discussion or just for thoughts on it. So the first one is with the weather, Publius. What do you think of a function, so a weather reducing function, that only kicks in or only takes place when we are selling out of soil for 2 consecutive seasons in a row? So this means that only whenever we're in the complex calculation of demand for soil. So when that happens, this is when we reduce the weather by more than 3%. Still there?
Yeah, Publius, if you're hopping in with an answer, we can't hear you right now.
Can you hear us now?
Yes.
Sorry about that. So to answer your first question, Mod, this is actually something that we've thought about a lot, which is in certain instances, is it appropriate to decrease the weather more than you might otherwise? And this is particularly the case when you have excessively high debt. But the question is, what would be the trigger or the cause of that? And multiple consecutive seasons where there was complete demand for soil is certainly one way to do it. Maybe it could be multiple consecutive seasons, not necessarily 2. Not opposed to that idea. Don't think it's the most substantive in the grand scheme of things, so it's not something I've spent too much time really fleshing out, but there's nothing wrong with this idea in theory. I think the real thing to highlight would be that you would just want to ensure that this was a period of real excess demand for soil, and you would also want to move the weather down quick enough such that you could continue to measure, demand for soil accurately and get a sense of whether the decrease was too much or not. And then if it wasn't too much, maybe you want to decrease it again at the same rate. So it's a question of not just doing it once, but does that increase again or decrease again and again and again in a jump fashion? So some complexities there, but very interesting to think about and totally in the right place.
Thank you. And I was thinking, so if we think that this is a good idea, then how much to bring it down, as you said. And I was thinking there are 3 ways of doing that. One, first of all, it can just be a set value, like we say, like 3%, then we bring it down by 9%, and that's it. It always only kicks in at 9%. Or it can be a percentage of how much we're minting, or it can be a percentage of what is the weather. So we say that whenever this happens, then the overall weather reduces by 5%.
Yeah, I think at first glance, I'd be inclined to have something closer to the first idea, or, in the spirit of the weather changes are all fixed amounts. I think this would most likely fit into the model as like a fixed condition where there would be, a larger fixed decrease in the weather. But a lot of different ways to go about it here.
Thank you. My second question now is about issuing soil again when we are selling out of soil in 2 consecutive seasons in a row. So I understand that we're always issuing soil because we always want to be able to measure demand. But is there real value in measuring demand when we're selling out of soil, consecutively? Do we care really? What's the demand then?
That's actually the thing that you need to measure, right? Let's say the system lowers the weather by X%, 3% currently, or 10% in the future, according to your first question. It's very important that Beanstalk can compare in consecutive seasons how that change in the weather affected demand for soil.
Yes, and we continue to issue soil, as long as, so we reduce the demand and then we're issuing soil And if we're still selling out of it, we, even after we're reducing, it sells out, then we continue to do that. But I want to separate them though, the two, the first and the second one, because we can still do the second one even if we don't reduce soil at oil.
You can decrease the weather, but you don't know whether you decrease the weather too much unless you have soil, is the point. And if we talk about creating sustainable peg maintenance, the goal is for any time there is soil for there to be demand for soil. And therefore, it's very important that if Beanstalk is lowering the weather, even if it's a small amount of soil, it can use that to measure whether it's lowered the weather too much, too little, or,
Okay. I got that. If anyone else has another question, I can stop and come back, or I can continue. What do you say, Dumpling?
Maud, I just have one question that fits right in here. So I might ask it, and then we'll get back to your questions, if that's okay.
Yeah.
So Publius, a question that I have, and I think I was chatting with Austin about it as well, is it seems like there's a minimum soil threshold where the gas might be causing a friction. So like if it's under probably 200 or so, if the soil, I would almost call that soil then like dust, where it may be issued, but someone might be waiting for more soil to make it worth it because of the the transaction costs of the sow. So I'm wondering how that might affect things. Yeah, go ahead. I think
I don't disagree. I don't disagree that there's something to be said for the friction on the ETH market makes cases where you have 50 soil. That's hard to measure. Is it that there's no demand for the soil, or is it that there's just too much friction for 50 soil, and even if people wanted it, they're not going to take it, and that's totally reasonable. I don't have an answer for you as to like an easy solve around that, other than as Beanstalk grows, this is really just a scale problem. 500 soil is a lot less of an issue, but at the same time, it's important to realize that there is a fundraiser outstanding. And you could, if you wanted to sow, $240,000 right now into soil. Right now, you could, and no one's really doing that. So even though I think you have a very interesting hypothesis as to why, there may not be demand for soil, I think in practice, and there's also a comment to be made that it should be much more clearly displayed on the website. But that's separate from it, like just on an economic perspective. There is pods of it, new pods that you could access, even if it's not explicitly soil, from a protocol terminology perspective. But people aren't lending to the protocol right now, even though Beanstalk is willing to. So I would say it's probably not the issue at the moment.
So I totally understand that. But if there was, like, I'm imagining, like there was zero soil before, how often does a small amount of soil get issued? And if we're above peg, and there's like 50 soil, does that cause weather to increment by 1, or am I off base?
It's a little more complicated than that, but in short, it actually might be helpful. And I'm going to try to find it, but if someone beats me to it, I'm trying to drop the weather changes from the white paper. That page, hold on. I'll find it.
I know it also factors in how quickly that soil was gobbled up. But it just seems like if that, if there's like 80 or 120 soil or something like that, and yet we're above peg, it just strikes it weird that we're above peg, pretty much all the soil's gone, and yet, the weather is increasing. I mean, that was just, yeah.
I just dropped in class discussion a photo of the white paper and the weather changes. So I think the one place we might highlight is if you look in the top right, or I guess the top chart, and you look at coordinate 2, -1, how that's a 1, whereas the rest of the column, y equals -1, are all zeros. I think the fix to what you're talking about, Dumpling, would be, because again, this is the case where the price is greater than 1 and there's no demand for soil, basically, because there's only 50, for example. That's the special case. Or it's not a special case, that's the general case. If you change this to a 0, that would basically mean that Beanstalk doesn't raise the weather. But when the price is greater than 1 and there's decreasing demand for soil, so that might be like the quick fix. And I mean, there's something to be said for proposing a BIP to do that, but I think that would probably be the simplest way to address it from a pure economics perspective. I don't know if it's the best long-term solution, and we're hesitant to propose short-term fixes like that. But at the same time, there's a strong argument to be made that would be an increase in efficiency in the weather maintenance or the weather changes system, at least for the next couple months, while Beanstalk is closer to its current size.
And would you set a minimum threshold of like 200, like if the soil, or 100 or something along those lines for when it is, then that's when it doesn't go, that's when it goes up by 0?
So it's funny, right? This is more of a general question because the white paper also has to figure out, well, what is the threshold below which you start using time instead of just demand for soil over the season? And there's a lot of different factors that go into that number, but as soon as you define it explicitly, it does become very exposable to manipulation. Like you can sell all but 200, if you will. Now that's, again, we're speaking a little bit more theoretically, so it doesn't prevent that from being a quick fix, but we're not the biggest fans of quick fixes for Beanstalk and would almost prefer to just let the model play itself out, even if there are, due to its size, short-term inefficiencies.
I wonder also if there's, we don't have to go down this road too much, but I think that I was just thinking maybe there's a way you could sort of almost make it a higher percentage chance that this happens as you approach that magic number, but you didn't announce what that magic number was. Like if it was, say it was under 200, if it was, the soil was 195, then it'd be like a 98% chance that the weather doesn't increase and a 2% chance that the weather does increase. And you could sort of scale it up like that based on some kind of, well, anyway, we obviously, yes.
Yeah, that's a little, there's beauty in the simplicity, but it's all interesting to think about.
Yeah. Okay. Ahmad, you're still up on stage. I want to see what your questions are.
Yeah. Thank you, Dumpling. Publius, what do you think of the current percentages of bean that's between the liquidity pools, silo, and circulation? Where we stand today, most of the beans are in the silo, so that's around like 80%, and then you have 11% in pooled and 3% in circulation. Do you foresee this percentages changing as we grow? And when we do, what do you think the ideal percentage would be?
Maude, this is actually one of the rare questions that I don't have basically any answer for you. I don't think that Beanstalk really cares about the distribution of beans that are in the silo versus not in the silo. When the system is young and there's not a lot of use for beans or stalk or seeds outside of the system, you're probably not going to have too many circulating beans unless the system collapses, because most of the returns are in the silo or the field at the moment. But you'll see an increase in circulating as a percentage as like the ecosystem expands and there's less stuff that just exists in the silo. But I don't really, I'm kind of unwilling to speculate because it's kind of non-substantive. So it doesn't really matter, and therefore, would rather not make it up.
Okay. I just wanted to take us through this, thought process or think about it for a bit. If we say that the demand, because our objective is to become the currency, right, and our strength is that we can meet any demand. So in that case, when we are such a currency, is it fair to think that it would only make sense for it when we're at that stage that the circulating percentage is the highest, more than the silo? I mean, it's not that the majority of the people are using this currency just to silo it; they are using it to use it. So is this first assumption fair to think of? So when we are big enough and we have become, the currency that's being used, then it makes sense for the circulation percentage to be, maybe not the biggest, or at least the bigger than both silo and pooled beans.
Yeah, I think that's generally correct. I mean, it's all a question of what scale are you talking about. If beans are generally like a deposit account for people all across the world, well, then your rate of circulating beans may be like a larger macroeconomic indicator, right? So there's a million scales that you can analyze this at, and that might be what makes it so hard to speculate.
Yeah, and when that happens, then bean is, or let's say that you are more susceptible to volatility, or you are more stable basically when there is high percentages in the silo and pool versus in circulation. So basically what I'm saying is that the challenge is going to be more challenging.
Well, I would actually push back on that, because the goal is for the withdrawal time for the silo to come down to near zero, and that therefore that shouldn't be the case.
Okay. Last question is maybe just for fun or just to brainstorm. I don't know if I think like we might have be aware of Polymarket and the recent fine that they got. For those who are not aware, Polymarket is like a prediction market that recently got fined by the U.S. Government, and they will continue operations outside of the U.S. And even though they're decentralized, the reason they weren't really decentralized is that everything still had to go through Polymarket itself. And then this spurred up a new discussion of for you to really have I guess to really have anything decentralized, you have to have a decentralized currency. So do you see this as a kind of opportunity or just noise, Publius? When we have prediction markets right now that are for them to really work out, they have to really use decentralized currencies.
Well, there's a lot of noise out there, but like the Polymarket thing that you pointed to or highlighted really does show the bigger opportunity at play for Beanstalk. And so we don't necessarily pay attention to the day-to-day fray around, particular judgments or fines or fees, but it's very clear by what's happened with Diem and Facebook, for example, that the federal government they're not playing ball at the moment. And cryptocurrency and DeFi needs to kind of make a decision whether they're going to just wait around for the government to give it the okay or not. And to that extent, there's real meaning behind the value of decentralization in that context. And so we are big believers that at some point, Beanstalk will start to demonstrate enough stability that places like Polymarket and protocols like Polymarket, start to consider Bean as an alternative because of, for a large reason, the regulatory environment, in addition to the economic benefits of having a positive or neutral carry stablecoins. So certainly think from a macro perspective, things like that point to an opportunity more than anything else. But don't necessarily have comments on the specifics of Polymarket per se.
Thank you, and I also think it's an opportunity. Even though probably our bigger one is, in my opinion, is being able to meet any demand, and then second comes, that you're truly decentralized. My last question, and I'm sorry for taking this long time, Publius, what would be your best explanation to the recent rally? The way I'm looking at it is this is mostly attributed to the rise in the price of ETH. Am I reading this correctly?
So there's certainly some strength in the Bean system that's the result of the strength of the ETH market and the cryptocurrency markets in general. But I would almost highlight that with the growth of the curve pool, the effect of ETH on the ecosystem and the price of Bean has decreased significantly. And so I mean, it can't be understated that ETH increasing 20, 30% in short periods of time is meaningful to Beanstalk at this point in time. Like we're not hiding from that. But at the same time, like there's $3 million in the curve pool that's been added over the past couple of weeks. There's been hundreds and hundreds of thousands of dollars of silo deposits, both Bean and LP, from a bunch of different wallets over the past couple of weeks. So I think it's a combination of ETH strength and then a lot of Beanstalk native network effects and headwinds, or excuse me, tailwinds that are pushing things in the right direction. So certainly a lot of it is the ETH strength, but I think that there's also a lot of good things just Beanstalk native that are happening that are good.
Thank you, Publius. Appreciate the time and the answers.
Okay, thanks, Maud, for all your questions. Rex, go ahead.
Hey guys, just wanted to quickly get Publius's thoughts on the hearings today, the congressional hearings with the Treasury and Undersecretary, and just sounds like there was a lot of discussions, and interested to hear what thoughts might be.
Not to come off as ignorant, but didn't pay any attention to them. I was working all day.
Yeah, so the long and the short of it is that the Treasury Undersecretary of the Treasury was talking about or trying to push for stablecoin issuers to exclusively be FDIC insured banks in the United States, and so that could potentially limit the ability for.
I mean, things like that are not surprising at all. The Federal Reserve has made it very clear that they are both not really looking to develop a CBDC themselves and are not cool with like Circle issuing stable coins. And so them saying, we really want everyone to get a banking license, and then they're actually going to restrict the banking charter. They're going to restrict who can get those. Like, Cynthia Loomis, the senator of Wyoming, recently wrote a good article on the Wall Street Journal highlighting that the Fed isn't approving Kraken and Avanti, I think, for banking charters. And, they may talk with something like Project Hamilton about a CBDC framework, but they're all talk, and they're going to drag their feet left and right. And I think, without speaking too specifically, because we don't want to put a target on our backs more than I feel like we already have starting Beanstalk, Do Kwon made a great comment on an interview, I think it was on Bloomberg or something recently, where he was like, listen, he's not so concerned with the regulators, and that may be because he's not in America per se. But I think more generally, that's the attitude that any decentralized protocol that's serious about being an integral part of DeFi needs to have. And so when we talk about decentralization, we mean it. And while currently there's certainly some parts of Beanstalk, like the website and all the, there's just a lot of different places across the board that could be further decentralized across the stack. We're working to make that happen. And we really think that's going to be, aside from a strong product market fit, the thing that makes Beanstalk last in the long run.
I appreciate that insight. And I guess the other thing that is kind of on my mind right in that same realm is, is there a potential where Beanstalk changes its reference peg, where we say, okay, because of, how the political winds are changing or whatever in the United States, we're going to change to a different peg because that gets us, further away from that centralization, or any thoughts on that?
Well, here's the beauty of it, of being decentralized. Beanstalk really doesn't give a shit. And more than that, Beanstalk can, once people believe in the credit of Beanstalk, and there's demand for soil, Beanstalk can issue assets, beans pegged to arbitrary value pegs. The demand for those different pegged assets is what's going to determine the supply of those different pegged beans, not Beanstalk or any decision maker. And it's very clear based on the current structure of the stablecoin market that the vast majority of demand for stablecoins is USD stablecoins. So while there's a lot of more interesting ideas around like a BTC peg stablecoin, I mean, I don't think that that's going to make a difference in the long run. And the point is Beanstalk is and will continue to be developed in a fashion that realizes, you know, there's a lot of people in the government that are going to be unhappy about this if it continues to work.
I appreciate that insight. And admittedly, I agree. It's just nice to hear you say it.
Publius, can you give us a quick? The pod marketplace just came out this last week, and if you haven't seen it yet, it's gorgeous. But I just wanted to get your take on kind of a before after, like what your expectations were going into it, about how many people would list, what pods would trade for, you know, the whole thing, and you know, now seeing it in action, kind of comparing those two.
Well, you know, not to overstate my excitement, you know, and we did tweet a little bit about it, but I mean, it's really fucking cool, you know? Like, this is a novel debt asset. It has its own structure, and now there's a DEX to support it. Just like, you know, kid in a candy store. But with regards to expectations and how those have been met, I mean, candidly, the farmer's market is like very much an MVP, and there's a lot of efficiency upgrades that can be made, which are basically listed at the bottom of the farmer's market section of the white paper, that explain how the market can be significantly improved in efficiency and structure. And, you know, want to give Beanjoyer his credit because he did a really amazing job getting the MVP up and running. But at the same time, you know, just from a pure economics perspective, it was evident that it wasn't going to be like the most liquid market at the start. And so I think we were generally impressed by the amount of, we were actually really impressed by the amount of listings. The number of, or the amount of orders was more in line with our expectation, whereas I think the number of listings exceeded our expectations. We are still expecting, you know, the listings to come down a little bit in price. They seem a little bit high in our perspective. I'm kind of making that up, but, you know, again, not financial advice, but that would just be my initial expectation was that the market would settle a little bit lower. Like, if you're just looking at the pod market chart right now, there's almost like a linear decrease at the moment in the bottom left of the chart, whereas you'd really expect that to be where the meat of the curve is. And once you get out to like 300 million in line, there's not going to be that big of a price difference between 300 million and 500 million. So still looking to watch that curve, you know, increase in its curvature a little bit, if you will. But overall, just very cool to see. And I think it's just a big step for the ecosystem in terms of developing as a more sophisticated financial, you know, protocol and ecosystem.
Definitely. And like the kid in the candy store, yeah, I was just watching it, refreshing, looking at it, you know, for a solid hour, 2 hours right when it came out. It was really cool. So yeah, that was awesome. And thanks to everyone for all the hard work that went into it. Okay. I have from Dr. Beans here. I have, do you see a scenario where there's less than 1 billion bean on the market by the time this debt cycle completes? And what initiatives are being worked on to create opportunities for this level of demand, / what are the key drivers for 1 billion bean demand within the greater ecosystem? So there's kind of a couple of questions in here, but I'll let you take that.
Well, the billion beans thing it's probably a good target for general deleveraging. I mean, it's like, what is the level where you'd say, okay, the system is deleveraged? Certainly like 15%, but given the current structure of the soil, that's not going to happen anytime soon. That would be at like 10 billion. And so when you say a larger deleveraging, I mean, like $1 billion would probably get the debt level of the pod rate to a couple hundred, low hundreds, and that would likely constitute a larger deleveraging. I think that's probably low hundreds is my best guess. And then with regards to, well, how do you actually get there? One, it's very important to realize that you don't need $1 billion. That's the main difference between Beanstalk and a collateralized stablecoin. You don't need $1 billion of demand or collateral to mint 1 billion beans. At the margin, you just need more demand that starts printing, and then you need a lack of sellers or a lack of supply such that the printing continues. And the question is, well, what are we doing or Beanstalk Farms doing to create supply and prevent people from selling because they have an expectation that Beanstalk is going to continue to grow? I would point to, I mean, there's a lot of different things going on. One of the things that we're going to hopefully publish in the next couple of days or weeks is a slightly updated roadmap to lay out some of those things. But having the silo accept various different LP tokens, like the Bean3 curve LP tokens, for example, is a big step in that direction, which will greatly improve the ability for Beanstalk to integrate with other protocols and tokens. Furthermore, integrating the Bean3 curve pool into the Oracle and the minting schedule, that's a really big one when it comes to increasing the rate at which beans can print, given a similar amount of demand. And then I think when we take a bigger step back, stock and seeds becoming liquid and creating a wide variety of different opportunities to use a yield-bearing token across Ethereum, that's potentially a really cool growth opportunity in and of itself. And so I think there's just a lot of different, it's hard to say which will be the main driver or the big kahuna. But there's a bunch of different things across the silo, the Oracle, and liquidity for stock and seeds, among a couple different other things like marketing campaigns and Beanstalk Farms creating a brand that I think all will help create an environment where that type of growth and adoption is possible.
Okay, great. And also from Dr. Beans, how do you see the game theory of playing? How do you see the game theory of players having so many pods riding on the success of Beanstalk? Does Beanstalk have a market maker or a group of market makers that are willing to support the peg?
Well, those are totally different questions, in my opinion. With regards to the latter, I think if you just look at the on-chain data, there's an increasing number of different ARBs that are buying low and selling high, which is really interesting. And then with regards to the question of what is the dynamic of having so many pods outstanding, I think it's primarily that there's a lot of people that are really incentivized to work on Beanstalk growing to get their pods to harvest. And specifically given the first in, first out harvest structure, and that Beanstalk doesn't mint when the price is below 1, you don't really have the chance that people are going to all at once run and stop working on the protocol. It may be a small trickle, but the point is there are always going to be people in the pod line working to develop Beanstalk, even if it's in a self-interested capacity. And that's in addition to stockholders.
Got it. Thank you. Syncubate.
Hey, good evening, everyone. Do you hear me okay?
Sure do.
Great.
Go ahead.
So yeah, just to kind of follow up on Mod's question, and I believe Rex, I have a much greater appreciation based off of recent events and just kind of looking at the landscape of DeFi in general, of the restraint that I think Publius has shown with the protocol and liquidity model. I understand now. I have a better appreciation for why, perhaps from a scrutiny perspective, in the long run, and also from a decentralization perspective, that's not ideal. So, kind of following up on that. My understanding also is that, in alignment with that, Beanstalk doesn't want to have, or wants to minimize friction as much as possible within its, at its foundational layer. And I was thinking about the farmers market and some of the recent events some of you might have seen yesterday. I believe Super Rare terminated one of the team members. They kind of, long story short, whether you agree with it or not, I think the team member had posted some, according to some people, what were offensive song lyrics from years ago. Somebody dug that up from Twitter, and I noticed a lot of prominent people on crypto Twitter saying that they were selling their super rare tokens, whatever, blah blah blah. And it just got me thinking, like, about the farmers market, but then also about the potential for expanding the utility of Bean across DeFi from an NFT perspective. So I'm going to focus. I have two parts to my question, Publius. With the farmers market, you need beans to buy pods, and we've had a very spirited discussion in the economics channel over the past few days, and I really just want to thank everybody that has contributed to that. I think we're all passionate about wanting to see this project succeed, and I think that manifests itself in different ways. So just want to thank everybody for that. I think we've had a much more constructive conversation in recent days, so thank you for that. One of the things I've been thinking about is, can the farmers market become sort of like an extension of the field in terms of supporting the peg? And by what I mean by that is, since you already need to own beans, you need to purchase beans to buy pods, would it be a quote unquote tax if the system charged both on the buyer and the seller side a percentage of beans that would then be burned upon the sale of the pods, and the burning itself would not equate to new pods? So it would be to the benefit of everybody, essentially. I've had some discussion with some people that said, this would be an added friction. My thought on this is it wouldn't be, because you already need beans to buy pods, number one, and number two, the fee itself wouldn't be going to like a treasury, right? Beanstalk doesn't want to have a treasury. We're all about decentralization. The idea of burning the beans would essentially be it would enable.
Not to cut you off, Syncubate, but like a fee is a fee. It's like, you can tell me if I want to buy a candy bar, and you say, well, the candy bar is $1, and I say, okay, I'll buy the candy bar for $1. All right, well, here's 99% of the candy bar. And I'm like, well, what? Like, I thought I bought a whole candy bar. You're like, well, you can buy a whole candy bar, but you got to pay more for that. Any way you slice it, they're still charging people more for the same amount. And there's actually, you're totally right. There's a real argument to be made that in the case of the farmers market, that's not friction in the traditional sense in terms of the model. And in fact, if you're burning beans or burning pods, whichever side of the market you decide to charge, you're benefiting the ecosystem as a whole. That may be at the micro level, but let's just think big picture. The real goal from a macro perspective is for Beanstalk to create the most efficient market possible for soil. When there is demand for soil, everything is hunky-dory. Like, the system is good. And so from a macro perspective, I would argue, and you could argue that it's too marginal and doesn't make a difference, that imposing a tax such that the benefit or your future expected value of a pod, if you're going to sell it on the farmer's market before you redeem it, is decreased, that at the margin could decrease the demand for soil, or in another sense, increase the weather that Beanstalk has to pay for soil. So on the one hand, if you're arguing that it's just a marginal increase in the weather, but it's not going to change the demand for soil, then you could actually make the argument that it makes sense to impose that tax. I don't have a strong opinion which way that would cut at the moment, but as you know, we tend to err very strongly on the side of no fee or no tax, and so this doesn't sound like something that there's really a benefit there, like in general. And then it's like, so if there's no benefit or there's a super marginal benefit, what's the cost? And I would say it's either a marginal or a slightly larger than marginal cost. And if that's your benefit and that's your cost, not sure it makes sense to implement at the protocol level, given it's pretty against the ethos of the protocol, which, low friction is even in the white paper. So not sure if that answers your first question, or if you had another question.
Right. I guess from my perspective, I just don't see it as a tax because it's not going to. The fees are not being collected by a central authority.
Syncubate the candy bar, the fraction of the candy bar that you're taking away, I'm taking away from you. It's going to go to a child that is starving. Like, it's going to go to a great cause. Nonetheless, I'm still taxing you for it. So it's separate from where is it going. It may be no one gets the pods, no one gets the beans. It gets destroyed. So everyone benefits. At the margin, you're taxing an individual for some general benefit, and I'm not sure that is aligned here.
Okay, on a separate note related to that, on the NFT front, I'm looking at the big players in the NFT market: OpenSea, LooksRare, and SuperRare. OpenSea charges 2.5% upfront on primary sales. LooksRare, everybody's familiar with that. It's a fork of OpenSea, very popular right now. 2% charged on primary sales. SuperRare, 15% charged on primary sales. SuperRare, just their top artist sold a piece for 120 ETH. SuperRare got 18 ETH as a fee. My question is, if we were to launch an NFT market to drive the utility of Bean, would a fee be a friction? I don't see it as a friction because all the other prominent players are charging exorbitant amounts.
So
and you see, right?
Let's take a big step back, and I'm sorry to cut you off again.
No problem.
In the grand scheme of things, from just a pure markets perspective, if you look at Uniswap versus Curve, Uniswap charges a 0.3%, or at least Uniswap V2 on all trades. Curve charges 0.04%. That's a huge difference in the grand scheme of things. And so you may say, well, what's the difference between 0.04% and 0.03% or 0.02%? Whereas the economist in me is like, well, that's double the fee. And so in the grand scheme of things, one of our high level goals for Beanstalk is to actually have a Beanstalk DEX, which I don't think this is something we've really spoken about before, but the beauty is that you can have a really high quality liquid DEX because of stock rewards, such that there's an attraction of liquidity because of stock rewards, but you can actually have no fees whatsoever. And so the attraction for adding liquidity is the stock rewards, but the attraction for using the platform is that there's no fees whatsoever. And so from a pure economics perspective, in our opinion, one of the real beauties of decentralized open source tech is that it's a race to zero when it comes to fees. OpenSea was forked where someone said, okay, we're going to undercut your fee by 20%, and they've started to take over market share. So this is a race to zero, and I would argue, this is where, sure, at the end of the day, you may be able to get a product market fit with 1% fee or 0.5% fee, but it's not sustainable, and any fee that you end up introducing is get undercut by a fork that says we're going to lower the fee by an arbitrary amount.
Okay, cool. Thanks.
Hi, guys. I agree here with the marketplace thing, because this is then going and competing against OpenSea and all. It becomes a different kind of business, and you're charging for something different than the objective of it right now here, which is bringing up the demand for Beam. Publius, you just mentioned the DEX. What are you foreseeing it? How will that work? What will it do?
Yeah, don't have like too many thoughts to share, but the general idea is, with any decentralized exchange, there's a question of, well, what are the exchange algorithm that you support? Is it a constant product formula? Do you support different formulas like the stable swap algorithm? Do you support multiple assets other than just two assets? These are general things where it's like there's a wide variety of different exchange protocols that are all doing cool stuff, but at the end of the day, they don't have, they have to create demand for their governance token or their emissions token or whatever the specific system is through fees. And those fees are a friction. And one of the main reasons, in addition to the stable swap algorithm like Curve, is advantageous to Uniswap is the low fees. And so again, if you keep in mind that fees are a race to zero, the question is, well, how can you actually offer zero fees or as close to zero fees as possible? And the chicken and the egg around liquidity is, sure, if there's, a place you can trade and get the same price and pay no fees, you're going to choose that venue. The question is, well, how do you bootstrap liquidity at those venues, at those DEXs? And I think using stock rewards, Beanstalk will be able to attract liquidity. And in doing so, you'd be able to create kind of the ultimate decentralized exchange. That's a little bit further down the road, so I don't have too many thoughts other than just from a theoretical place how that would work, but it seemed relevant given the discussion.
Thank you.
I'm just looking over the class discussion, seeing if there's anything I missed. I see NASDAQ is quite excited. NASDAQ, do you have any questions? I don't know if you're at a place where you can speak.
Yo, what's up?
Hey, how's it going?
I was just saying that's pretty huge. Are you essentially saying that you're going to, you've been talking about implementing a gauge system and everything? Is this kind of like overtaking Curve? Like if everybody starts swapping their stables in the Bean DEX, and then, so I guess like that sounds huge. One, how will that drive demand for beans? Will that just kind of like show people that they should silo and sow, and like it gets attraction to the platform, and then people start buying stock and seeds? And then two, like how to get there. My quick thought was that, okay, we need ERC20 tokens for the silo, and then we also need stock and seed tradable, and then we can kind of start building that. Yeah, I mean, you've only just started talking about this, so only just started thinking about it, but let me know if that makes sense.
Well, first off, when we push back, it's not you, it's we. Basically, everyone in this call is probably, most of the people in this call are going to have a hand in all this. I think to answer your former question, and it's related to the second question, the real starting point is beans. What makes this happen is beans being used as a medium of exchange. And so as you have more and more liquidity pools against beans on various different DEXs, the question becomes, well, in what cases can you actually do better once you have those liquidity pools? And if you imagine that the silo is going to be able to say, okay, well, all of a sudden there's no gauge rewards for this pool, but all of a sudden there's gauge rewards for another pool, and you can convert over, there is an expectation that you'd be able to pretty easily incentivize people moving over to the DEX of choice in a given instant, and doing that in a decentralized capacity. And so the question is, well, building out like a Beanstalk DEX, what does that actually look like, and how is it better? There's a lot of different questions there. I don't have too much to say other than the goal would be for it to be as flexible as possible. And if anything, and I say this with, I just don't like to talk about things that aren't well thought out enough where it sounds like we're talking out of our ass. But the other place where this really makes a difference is when it comes to the cross-chain implementation for Beanstalk, where having a no fee a DEX basically allows you to, with slippage only on your price, on your execution price, basically go from any asset on any chain that Beanstalk is on and has liquidity against to any asset on any chain that Beanstalk is on and Beans have liquidity against. And so when we talk about, well, where does this come in? This is actually part of like the larger Beanstalk ecosystem and creating like a hub for DeFi. And, I think the stock and seed liquidity and the silo upgrade, that's all part of it. But this is going to be a larger development project. And I mean, by the interest in the questions, on the one hand, I'm glad that we mentioned it because it's great that there's so much interest. But on the other hand, don't want to sound like this is something that's a couple weeks away. This is more like high level planning on what the overall ecosystem should look like.
That's very fair.
Awesome. Thank you. Yeah, that makes sense. So 2 months. No, I'm just messing around. Awesome. Thank you.
Thanks for coming up.
We can either spend time on classes and calls, or we could disappear for 6 months and then all that stuff would be ready, but it's difficult.
Not to build a crazy idea on a crazier one, but if Beanstalk anyways can peg anything or be pegged to anything, so can we sort of have like a DEX that can sell you anything? So we don't even have to have it. We can just sell you whatever you want, and then we create the list of everything, and we become the DEX of everything. Does that make sense?
Meaning like you want BTC beans and you can just get BTC beans for Beanstalk, or what do you mean?
Yeah, so the same way that we're having beans that are pegged to the dollar, so we can have other iterations of it that are pegged to anything, and then we can buy and sell you anything on our platform.
Correct.
Okay. Very, very excited to see how this progresses and where it goes.
Hey, Mr. Manifold.
Hey, Dumpling. Hope you're doing well. I just wanted to give a shout out to Jim. I see this is his first time in here. Really smart dude. So welcome to the Beanstalk community. We're glad to have you, buddy.
Hey, Jim.
Publius, just kind of expanding on that. Well, actually, kind of like Mod said, and now this conversation, I don't want this conversation to get like too meta or too out there, but just a thought I had is, like Mod said, if you can kind of create synthetic assets, I don't know if that's the right word, so just, shoot me down if it's not, but like if you're just trading like, BTC Bean versus, or like, yeah, like Bean BTC.
You're trading credit. You're basically trading credit, Beanstalk credit in a denomination, whether that's denominated in dollars or BTC or whatever.
Yeah, right. And so like, I don't know if you looked into like synthetics at all and like how they trade synths and how the supply of synths is kind of limited by the C ratio of that protocol. But this would kind of flip that model upside down and kind of allow for unlimited scalability, hypothetically, that because the credit is much more scalable.
It's the same flip from collateral to credit, just from a dollar stable coin. You're now applying it to every other asset. So the starting point is the dollar, because that's where there's the most demand. And so from a creating credit perspective, that's the starting point. And maybe I would just say, Jim, welcome. You should know that we're a serious community, and these conversations are not, they're not a joke. And if anything, it's just that we have these calls every week. And so, at some point we do get into the philosophical or the ideal. But at the same time, we mean business, and we're not just saying this.
Cool. Yeah. Going to think about that some more. Really interesting.
Well, okay, guys. I think this was a pretty successful class. A lot of interesting stuff brought up here. There will be some notes distributed in case you came in late and you want to listen to the recording. Jim, do you have? You want to come up for a second, ask the last question? Guest of honor here. Okay, or maybe you're just waving. That's fine too. Yeah, anyway, if you want to listen to the recording, to Bean or not to Bean, he'll be posting some notes and the recording, so you can look for that. And yeah, thanks for coming. We have a meeting at 8:30 Eastern time on Thursday, so that's it's a Beanstalk Farms meeting. So we're in discussion also of having monthly DAO meetings as well as the weekly Beanstalk Farms meeting, which is usually project-based and open to everyone. So anyone can come, and there's usually some open time at the end of those meetings too if you have any questions about specific projects or initiatives. So feel free to come to that. And that's in the calendar here at our Discord. So again, thanks for coming, and we'll see you all soon.